We begin with Chapter 3. In this chapter, we will analyze in detail the long stock position. Before analyzing the different positions that we can take to invest in options, we will see in detail stock positions. So now, we will apply the criteria seen in the previous chapter in order to facilitate their understanding when we use it with options positions. The long stock position is used when the market outlook is bullish, and the strategy consists of buying shares of stock. Here we can see the risk graph of the position. What we are seeing is a graph with two axes. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. It is important to mention that the values do not include brokerage commissions. The maximum profit on this strategy is unlimited because the increase in the stock price has no limit. On the other hand, the maximum loss that we are exposed to is limited. The most we can lose is equal to the purchase price multiplied by the number of shares. This occurs if the stock price falls to zero. Regarding the break-even point, it is equal to the purchase price. The break-even point defines the profit and loss zones. In our case, for stock prices lower than the break-even point, we are in a losing situation. In contrast, for stock prices higher than the break-even point, we are in a profitable situation. Continuing with the analysis, the initial margin required to open the position is equal to 50% of the cost of the shares. This is the minimum amount of money that must be deposited into our account in order to place the trade. If we buy the shares on margin, the broker lends us the other 50%. Regarding volatility, an increase in it helps the position. On the other hand, time decay has no influence. With respect to exit conditions, to close the position, we must sell the shares. If the stock price is higher than the break-even point, we are in a profitable situation. Otherwise, we are in a losing situation. To determine if volatility helps the position, we must consider the following. The higher the volatility, the higher the movement of the stock, whether it is bullish or bearish. Therefore, the higher the volatility, the higher the probability that the stock price moves away from the break-even point will be. In the case of the long stock position, the higher the volatility, the higher the probability that the stock price increases above the break-even point, which obviously helps the position. Let's see an example of how this strategy works. Here we are seeing the stock chart of the eBay company. As we can see, on August 19, 2011, the company gave us a clear bullish signal because the stock touched support, and this was accompanied by an increase in volume and an RSI below 30%. As we said, on Friday, August 19, 2011, eBay gave us a clear bullish signal. In order to take advantage of that, suppose at that time we had decided to buy 1,000 shares of the company. At the close of that day, eBay was trading at about $27, so the 1,000 shares would have cost us $27,000 or $13,500 if we had bought them on margin, that is, the 50%. A few days later, the stock started to rise until it reached the price of $31 on August 30, touching the 15-day resistance. That can be seen here. We bought the shares on August 19, the day we got the bullish signal, and a few days later, on August 30, the stock reached the price of $31, touching the 15-day resistance. If we had sold the shares at that time at $31, we would have made a profit of $4 per share because we had bought at $27. Thus, we would have had a total profit of $4,000, making a 15% return on investment in only 11 days. After August 30, the stock price fell for a few days, but then rose to a high of nearly $34 on Friday, September 16. At that time, the stock almost touched the 3-month resistance. That can be seen here. After August 30, the stock price fell for a few days, but then on September 16 rose to a high of nearly $34, almost touching the 3-month resistance. If we had sold the shares at that time at $34, we would have made a profit of $7 per share because we had bought at $27. Thus, we would have had a total profit of $7,000, making a 26% return on investment in only 28 days. Here, we can see the numbers of our example. The strategy consisted of buying 1,000 shares of eBay at $27 each. Therefore, our investment is equal to 27, which is the purchase price, multiplied by 1,000, which is the number of shares. That is a total of $27,000. This money is debited from our account. The initial margin required is equal to the 50% of the cost of the shares, that is, $13,500. This is the minimum amount of money that must be deposited into our account in order to open the position. The maximum profit we can make is unlimited, because the increase in the stock price has no limit. If we had sold at $34, we would have made a profit of $7,000. On the other hand, the maximum loss that we are exposed to is equal to $27,000. This occurs if the stock price falls to zero. And regarding the break-even point, it is equal to $27, which is the purchase price. Here we can see the order we must enter to open the position. It consists of buying 1,000 shares of eBay. In the side column, we select the action Buy to indicate the purchase of shares, and in the Position Effect column, we select the option To Open to indicate that we want to open a new position. The entered price is $27, and the order type is Limit. That is, we want to buy the shares at a maximum price of $27. In the Time in Force column, TIF, we select the option Day to indicate that we want the order to remain open only during the trading day. In the Instruction column, we select the specification All or None, AON, to indicate that we want the order to be executed only in its entirety and not partially. And in the Exchange column, we select the option Best to indicate that the routing of the order will be made automatically by the broker. Here is an example of the order we must enter to close the position. It consists of selling the 1,000 shares of eBay that we had bought. In the side column, we select the action Sell to indicate the sale of shares, and in the Position Effect column, we select the option To Close to indicate that we want to close an existing position. The entered price is $34, and the order type is Limit. That is, we want to sell the shares at a minimum price of $34. In the same way as for the order to open the position, in the Time in Force column, we select the option Day. In the Instruction column, we select the specification All or None, and in the Exchange column, we select the option Best. Here we ended with the chapter Long Stock. In the next chapter, number 4, we will analyze in detail the short stock position.